Hello everyone. In my Business 330 class, I hope everyone is doing well and continuing to do well anyway. Okay, so this is going to be the first part of slides for chapter 10. So there's about 85 slides on chapter 10, and we'll try to go over them. All right, so some of the goals we're going to learn about is how companies do capital budgeting, okay, and what is meant by the capital budgeting process. And we're going to look at what's called the payback period, right? We're going to determine what the payback period is, and that's a simplified way of looking at capital budgeting. And of course, the most important thing we're going to talk about is net present value and also internal rate of return, okay? And then we'll kind of skip over economic value added. I think that's a graduate level topic. And I don't think we have to worry about that. So we'll proceed. So here we are again, and what we'll do is we'll talk about internal rate of return. Internal rate of return is somewhat important, and it's a little complicated, but we'll talk about it. So and we'll try to compare net present value and internal rate of return, and we'll discuss conflicting rankings that net present value and internal rate of return are not always in agreement with each other. So we'll discuss what the differences are between them. Okay. Okay, so what is the definition of capital budgeting? And capital budgeting is the process of evaluating and selecting long-term investments, and emphasis is on long-term here, right, that contribute to the firm's goal of, again, maximizing shareholders' wealth. That's always the underlying theme in financing, because we're the owners, right? So the motives for capital expenditure. Now, your capital expenditure means what? Spending money or outlaying money, right? And why do we do that? Why do companies do that? And why do you do it? And they try to make the firm expects to produce benefits over a period of time greater than 1 year. So you outlay money to try to create more wealth for the shareholders, all right? And operating expenditure is basically a shorter term, within a year funds. Maybe you need some quick little improvements, or you just got to maybe give people raises or hire somebody, or just pay the bills in general, all right? So like a capital expenditure on your house would be when you put in a new bathroom or a new kitchen, you increase its wealth, right, your value, okay? But in that case, it's your own personal wealth or value, right? So that's what that's all about. All right, so there's 5 distinct processes we go to, steps or processes, when it comes to capital budgeting. First, you generate a proposal about what you want to do, right? You generate a proposal, and you figure out, you have meetings, and you come up with maybe a written proposal and say, we're going to come up with this project or do this. And then you have internal reviews and analysis among all the managers, and you decide does this project have merits and will it make us money? And I'm sure like Apple does that every time they release iPhones, and all companies do that, right? So you do that. And then you start making decisions. How much money we're going to give. It should be, and then you start authorizing expenditures. And maybe there's a production line, and they've given an example of a production line. Then you basically start implementing the project, and after everything's approved and the money's allocated, you start implementing it. And basically, while the project is going on and in the early stages of when it's completed, you monitor the results, and you have marketing. Now marketing steps in, and now the marketing people start looking at whether it was justified making the investment, and rather, you'll know pretty quickly if it's been a success or not, okay? And yeah, I remember when Amazon.com came out with their own version of an iPhone, and it didn't last long, and they pulled the plug on that. So, all right. So there's some terminology here that's important, and this is the most important terms you'll hear: independent versus mutually exclusive projects. Okay. So what is the difference between an independent and mutually exclusive project? All right. So independent projects mean you have enough cash. There's enough cash around to do all of them. So, for instance, if you don't have to worry about if I take one, will I not be able to take the other. So if you're loaded with a lot of money, you could redo all your bathrooms, your kitchen. Doesn't matter. They're all independent. You're going to redo them. Now, mutually exclusive means you're cash strapped and you only have enough money to pick one or the other. And you're going to do some research and you're going to pick the one that's going to make you more money. So, like in a simple example of you with a house, right? You would basically say, well, if I do the kitchen or the bathroom, which one is going to add more value to my house? And then likewise, a company will say which one is going to add more value to the shareholders. Which of these projects, because we can only do one. Unless, of course, we only have enough money to do the cheapest one. But then, be that as it may. So, again, the shares, these jumped. All right, so you have a choice. If you're going to do independent projects and you have enough cash and unlimited funds, you'll do them all, right? So unlimited funds goes with independent projects. They can accept all independent projects, and you go with that. And then capital rationing is with regards to mutually exclusive projects. And you got to make a decision. Do I go with these projects or don't I? You only have fixed money, and you can only do certain projects. So that's the whole gist of that. That's how the money's tied into the independent versus mutually exclusive. All right, so there's a term here called accept, reject. There's some ways of basing of whether or not to do a project, and these are very simplified. Accept, reject, or you're basically evaluating the capital proposals to determine, is there a minimum criteria that basically it'll make the shareholders rich, or then you have other projects. Do you rank them, and you rank the capital expenditures based on some measures about which one will create the larger wealth. So these are two basic approaches to capital expenditure. So when it comes to determining which projects to do, financial managers are going to need tools, and the magic word here is tools, right? And the tools are mathematical. Okay, you need mathematical tools to say, is this project worth doing, and does it have merit to make the shareholders better off? And we need time value and money approach, right? And we got to look at the time value of money, and we got to look at the risk return, the risk rewards trade off, right? So I mean, you got to say, you got to start comparing money on projects. So again, if you don't use time value of money tools and good mathematical tools, you're not going to accomplish what you set out to do, and that's maximize shareholder wealth. Okay. All right. So let's look at we're going to look at this company throughout these examples, Bennett Company, and we'll look at their cash flows, and it'll follow through. Okay. On all the examples. So basically, what they're going to do is they have projects they want to do. And here's the initial investment they're setting out to do. So here's their initial investment. Okay. So project A is going to require an initial investment of $420,000, and project B is going to require $450,000. And so here's the cash flows for project A. Here's the initial investment. Notice it's negative, right? And here's the operating cash flows. you'll see the first cash flow coming in is 280,000 for B versus 140 for A. So there's something that you should readily see here. Okay. How do I determine which of these projects is more worth doing? I don't have any tools, and I really can't make any justifications by what I'm seeing here in cash flows. Okay. So here's the way it looks on a timeline, just to make it clear to everybody. Here's your initial investment. That's always negative. It comes out of your pocket, so it's negative, all right? And here's the cash flows. And here is the initial investment. And here's the cash flows. All right, so the first method we're going to look at, which is not taking into account the time value of money, is called the payback period. And the payback period is very simple, and it suffers from a lot of problems. So it's really not used much, only in certain simple circumstances. And the payback period simply is the time an investment will generate cash flows over to recoup your initial outlay. But it doesn't take into account the fact that you could have taken that money and invested it somewhere and gotten a return on that money, right? So if you, for instance, as an example, if you lend someone $1,000 and they say they're going to pay you in a year, okay, and they do indeed pay you back. So you get your $1,000 back and you say my payback period was a year, but no, it wasn't, because first of all, you didn't get any interest on it, right? And you could have invested that money, let's say, in a 10% account and made $100. So your cost of capital was 10%, and you didn't get that. So technically, you didn't get the money paid back the way you thought. So payback period is a very rudimentary idea, and it's very subjective, right? So if the payback period is less than the maximum acceptable, you will accept the project, and vice versa, all right? If it's not, you'll reject it. But again, it's very subjective. It's a very subjective thing. So it's not something a lot of people use, except the very simple ideas. All right, so as this example shows, when we look at the Bennett Company, for the two projects, we can look at payback period for it, right? But so for project A, which is an annuity, the payback period is 3 years, right? And they show you that. And because project B generates a mixed stream of cash flows, the calculation of its payback period is not as clear cut. So at the end of year 3 for project B, $500,000 will have been recovered. Only 50% of the year 3 cash flows of $100,000 needs to complete the payback. So the you're left to complete basically that 50,000. So that's all you need. So the payback period for B is, if you take a partial for year 3, it's 2.5 years. All right. So it's 2.5. But again, you got paid back, but you could have possibly invest. You don't know how you could have invested that money. So that goes without saying. So if Bennett's maximum acceptable, and I don't know why that would be, payback period with 2.75 years, project A would be rejected and project B would be accepted. All right. So and if their acceptable payback period was less, like 2.25 years, both projects would be rejected. If the projects were being ranked, B would be preferred over A because it has a shorter payback period. Note, however, that no matter what payback period Bennett requires, it's unclear from payback analysis which investment will do them. You see, you don't get a picture of increasing shareholder wealth here from payback period. And they say that very explicitly here, right? You don't know. All we can say is that project B recoups the initial investment more rapidly than project A, but that does not take into account time value of money at all. So that's a problem that has to be addressed, and that's where net present value will come in. All right, so there's a little thing here about in India. So a 2017 survey of firms in India found that 2/3 of those firms always or almost always conducted payback analysis when they made major investment decisions. Similar to the results found in the U.S., small companies in India were more likely than large firms to use the payback approach for all its flaws. The payback approach still sees widespread use around the world, and to be honest with you, I don't know why. And I don't know why that really is anymore. But anyway, it's really not a good method. All right, so here's some of the pros and cons of payback, right? They'll use it for small projects to judge a larger project and or maybe several metrics. They'll use it combined with others, right? And the fact that companies love it is because it's simplistic, and they could have not have to deal with it. So by measuring how quickly the firm recovers its initial investment, the payback period also gives at least some consideration to the timing of cash flows, but it really not much at all as far as your investment and your cost of capital, what else you could have done with that money. So again, it's a very subjective approach. So it's simplified though. And it's a crude way to adjust for project risk, right? If you need faster payback. And here's my point, right? It's a subjectively determined number, and it's interesting how that number is determined. You'd have to get a good rationale for, well, why did they come up with that number? And the most important thing probably is this term right here, that no firm connection does exist between the payback period and the goal of shareholder wealth. But if you're looking for a simplified approach, I mean, it doesn't get any simpler than that, right? All right, I'm going to stop here. I'm about 18 minutes into this. I'm going to stop here and I'll make a part 2.